The stock market is a game of shifting narratives, and right now, the story surrounding Lucid Group is taking a definitive turn. As of the latest market activity, with trading closed for the weekend on this Sunday, May 17, 2026, Lucid Group, trading under the ticker LCID on the Nasdaq, finished its last live session on Friday, May 15th, at exactly $2.64 per share. This closing figure came after a highly volatile intraday session, where the stock pushed through intense selling pressure, ultimately managing a modest gain of 1.54% on the day. Looking at the broader chart, this minor uptick offers a brief moment of relief for retail investors watching the screen on popular investing sites, but it barely scratches the surface of the larger structural challenges the company faces. The trading volume during that final session of the week hovered right around 32 million shares, which is relatively close to its recent daily average. This suggests that while there isn't an outright panic selling event occurring at this exact second, the overhead resistance remains incredibly heavy. Institutional players seem content to sit on their hands, leaving the daily price action to short-term traders and automated algorithms. The common expectation among retail traders utilizing a standard individual brokerage account or tracking the stock on the Robinhood app is that Lucid is simply a coiled spring waiting for a massive short squeeze or a sudden influx of capital from its primary backers in Saudi Arabia. People look at the luxury design, the industry-leading battery efficiency, and the sheer technological prowess of the Air sedan, convincing themselves that the market is making a massive mistake by pricing this company like a failing enterprise. But the harsh reality, the one that traditional financial institutions and wealth managers at places like Fidelity Wealth Management are looking at, is that exceptional technology does not automatically translate into a functional, self-sustaining business model. The expectation is that brilliant engineering wins the race. The reality is that manufacturing logistics, capital burn rates, and macroeconomic demand destroy companies long before their technology has a chance to mature. This massive disconnect between what the car can do on tarmac and what the company can do on a balance sheet is where the real story of Lucid unfolds, forcing us to look past the shiny exterior and look at the brutal numbers governing its survival. When you look closely at the recent stock movement, the daily swings tell a story of immense distribution. Over the past quarter, every single attempt by Lucid to build a sustainable rally has been met with aggressive selling. When the stock attempts to clear major technical moving averages, institutional block orders enter the market to cap the upside. This indicates that larger funds, perhaps those managing massive portfolios through interactive brokers or structured institutional accounts, are using brief moments of retail optimism to exit or hedge their positions. The macroeconomic pressures of 2026 are not doing the company any favors either. We are operating in an environment where interest rates have remained stubbornly sticky, making vehicle financing incredibly expensive for the average consumer. Even in the luxury segment, where buyers are typically less sensitive to interest rate hikes, the willingness to drop over $80,000 on an unproven EV brand is shrinking. The entire electric vehicle sector is experiencing a massive cooling period, with even industry giants experiencing significant margin compression. When giants face headwinds, smaller players with negative cash flows get squeezed twice as hard. To truly understand why the stock is pinned down near these historic lows, we have to look directly at the cash flow statements and the persistent operational burn. In its recent quarterly reports, Lucid continued to show a net loss that alarms traditional analysts who look at metrics on a professional Fidelity trading platform or a Schwab Intelligent Portfolios dashboard. The cost of goods sold consistently outpaces the revenue generated from vehicle deliveries. In plain terms, Lucid is still losing an exorbitant amount of capital on every single vehicle that rolls off its production line in Arizona. While the company frequently highlights its total liquidity, which is heavily supported by the Sovereign Wealth Fund of Saudi Arabia, the market is beginning to lose patience with the timeline for achieving positive gross margins. Capital injections are an excellent safety net, but they do not solve the fundamental issue of production scaling and demand generation. Investors who practice self-investing and manage their own portfolios are forced to ask how long a sovereign entity will continue to fund operational losses without seeing a clear path toward profitability. Let's step back and look at what this company actually does and how it built its reputation. Lucid Group was founded with the explicit goal of defining the absolute pinnacle of luxury electric mobility. Their flagship vehicle, the Lucid Air, was engineered by individuals who played key roles in development phases elsewhere in the industry, including work on early high-performance electric platforms. The core proprietary technology centers around their incredibly compact, highly efficient electric powertrain and battery architecture. They managed to achieve an official EPA estimated range that surpassed almost every competitor, establishing an undeniable benchmark for energy density. Their business model was structured around a direct-to-consumer sales strategy, bypassing the traditional dealership network to maintain strict control over the brand experience and pricing. In the early stages, this approach generated massive consumer excitement, leading to a surge in reservations and an initial public offering that valued the company at tens of billions of dollars.
Early past performance reports showed a stock that skyrocketed on pure potential, driven by an era of cheap capital and intense euphoria surrounding green energy investments. However, moving from a brilliant prototype to mass production is an entirely different battle. The historical data showed that Lucid struggled immensely with supply chain bottlenecks, logistical delays, and manufacturing quality control during its initial production ramp. By the time they began to smooth out their assembly lines, the competitive landscape had shifted dramatically. Competing models arrived with aggressive price cuts, triggering a brutal price war across the entire automotive sector. Lucid was forced to lower its own prices and introduce substantial incentives just to keep vehicle deliveries moving, which severely damaged their projected margin trajectory. This historical context is vital because it proves that Lucid's struggles are not a recent anomaly. They are the result of structural challenges inherent in launching a capital-intensive automotive company from scratch. Comment below how many shares of Lucid Group you currently hold in your portfolio and whether you are buying more at these levels or looking to exit. As we look toward the future, the outlook for Lucid is entirely dependent on a few critical catalysts and a highly anticipated product expansion. The biggest narrative shift hinges on the production ramp of their new luxury SUV, the Gravity. The expectation is that the SUV market in North America is vastly larger and more profitable than the luxury sedan market, meaning the Gravity could tap into a completely new segment of affluent buyers and multiply delivery volumes. If the company can execute this launch flawlessly, keep production costs under control, and generate a genuine waiting list of buyers, the reality could finally begin to catch up with the optimistic market narrative. Furthermore, their ongoing technology partnership agreements, where they lease their advanced powertrain setups to legacy manufacturers, represent a high-margin revenue stream that could offset some of the manufacturing losses. This asset-light side of the business is what keeps many long-term tech investors engaged. Conversely, the risks are monumentally high. If the Gravity SUV encounters the same production delays and supply chain friction that plagued the Air sedan, the company's cash runway will shorten dramatically. The reality of a sustained high-rate environment means that dilutive capital raises remain a constant threat to existing shareholders. If the broader market experiences a systemic downturn, highly speculative, unprofitable companies are always the first to be abandoned by algorithmic trading platforms and institutional wealth managers. The core tension remains completely unresolved. The technology is undeniably brilliant, but the financial structure supporting it is running out of time to achieve independence. In summary, the central insights surrounding Lucid Group reveal a stark contrast between exceptional engineering achievement and harsh corporate reality. The expectation among enthusiastic retail investors is that technological superiority will inevitably force the stock price higher, especially with the backing of massive sovereign wealth. The reality, clearly reflected in the Friday closing price of $2.64, is that the market is heavily discounting the stock due to persistent operational losses, expensive manufacturing scaling, and a cooling global demand for premium electric vehicles. While the upcoming SUV launch and external technology licensing offer tangible catalysts for a turnaround, the structural headwinds and risk of further shareholder dilution cannot be ignored. Investors must weigh the undeniable sophistication of the vehicle against the immense capital requirements of the business, recognizing that in the current market environment, financial stability is valued far above unfulfilled potential. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.